Hello and welcome to Connect, the weekly podcast of the California MBA, featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA, and I'm very happy that you could join us today. Before I welcome today's guest, I'd like to thank our 2024 President's Council sponsors. These companies provide a tremendous amount of financial support to the California MBA, in large part so that we can continue to be the strong voice for the real estate finance industry before the California State Legislature and our regulators. So please join me in thanking this year's President's Council sponsors. And those companies are AmeriHome, Arch MI, CMG Financial, Consolidated Analytics, Funding Shield, Guild Mortgage, and Western Alliance Bank. Thank you all so much for your support this year. We greatly appreciate it. And that brings me to today's guest. I'm very happy to welcome Kris Kully, who is a partner at Mayer Brown. Kris, welcome.
Thank you so much, Susan, and thanks to the association for having me.
Yeah, it's great. I'm glad that we got this worked out. I always kind of like to start the same way. I'd love to hear kind of your journey in coming into legal representation in the mortgage industry.
Yes, I anticipated this question because I am a avid listener to the podcast.
I love it.
So I know that, like many of your guests, it was not particularly preordained, but I got into the mortgage industry because my first job was at the Department of Housing and Urban Development. So coming out of law school, I aimed for Washington, D.C. I wanted a job that would combine, legal skills with a public policy focus. So I targeted my job search at the public sector. I didn't really have a substantive area in mind, but I was so interested in HUD because the position was in the agency's Office of General Counsel in their regulations division. So I quickly started drafting regulations about all aspects of the agency, including HUD's funded programs like public and assisted housing or community development programs, FHA, of course, and HUD's regulatory work. So at the time, and this is going to date me a bit, but the agency had rulemaking authority over RESPA, the Real Estate Settlement Procedures Act, and it also had mission oversight authority over Fannie Mae and Freddie Mac. So not only did I get kind of my public policy fix, but in digging into housing policy and housing finance issues, I got a huge dose of the workings of capital, secondary markets, but all grounded in this foundational issue of where people live and how that shapes their communities. So that started me on my housing finance legal path. After working at HUD, then I joined a private law firm and focused not just on mortgage, but other consumer financial regulatory issues. So I still get a big dose of law, but also housing policy and high finance issues. So it's a great combination.
Yeah, yeah. Did you work at HUD when Ken Markison was there?
Yes, I did. In
Oh my
fact, Ken
gosh.
was my boss for several years there.
I don't
So
know that I knew that of all the
yeah,
years I've known you both. I miss
I
working with
was,
Ken.
he was a fantastic boss and I learned so much from him. But yeah, I helped him with some of those Fannie and Freddie issues. Yeah, so
Yeah.
that's where I cut my teeth, so to speak.
Such a great guy. Wow. I don't know that I ever knew that connection. So I'm glad that I asked. Now I know you advise your clients on a wide range of issues, but what should lenders be, what are some of the latest fair lending issues that lenders should be aware of?
Yeah, fair lending is always just such a hot topic for my clients and your members because it's a hot topic for regulators. And even if we think we're on top of it and we've conducted our risk assessments and our monitoring, there's still kind of a fear of the unknown. Like, what should I be thinking about that I'm not thinking about? But I don't think it's a big surprise that I think the biggest fair lending issue these days is redlining, lending practices that result in an unequal access to credit on a kind of a geographical neighborhood basis. So, I mean, traditionally, redlining was a concept that applied to banks. I mean, the thinking was that banks have a duty to serve their communities
Right.
based on their charter or the fact that they have insured deposits and there's the Community Reinvestment Act. But do independent mortgage banks have that kind of a duty? Is it the case that not only must they not discriminate, but must they do more? Must they reach out and ensure that they're serving neighborhoods and geographic areas equally? Well, we have a bit of an answer to that because the CFPB and the DOJ have a combating red line initiative. They're proactively going out to find redlining issues, and that effort has focused on banks and their lending efforts in communities like Jacksonville, Memphis, and Charlotte. But just last week, the agencies announced a settlement with a non-bank mortgage company, asserting that the company failed to serve certain majority Black neighborhoods in Birmingham, that the company's percentage of applications from those neighborhoods was much less than the percentage of other lenders. So the agencies looked at, or they did not look at just the number of applications received from those neighborhoods or the number of loans, but the percentage. So, I mean, just for example, even if the mortgage company had taken more applications and made more loans in those neighborhoods than any other lender, the agencies may still assert that as a percentage of its business, a mortgage company should have done more. So I think redlining and its focus are really important to keep in mind. The other hot topic has to do with how fair lending principles apply to encouraging or discouraging potential applicants. The redlining
Mm,
settlements have all focused on the extent to which the banks were using outreach efforts that may have discouraged minority applicants or applicants in minority neighborhoods. But you might recall that the lower court in the Townstone case, where CFPB sued a mortgage company, the court held that the Equal Credit Opportunity Act applies only to actual applicants and not to prospective applicants. So a mortgage company would not violate ECOA based on a theory of discouraging prospective applicants. However, the appeals court reversed that conclusion. So they held that discouragement is an activity that's covered by the statute. So if that's the case, then that means that we all need to look at our marketing and outreach campaigns, our application processes, our branch locations, and consider whether those efforts and processes could be discouraging applicants on a prohibited basis. And of course, appraisal bias is a top fair lending priority too. It's such a tough issue. I mean, how to walk that fine line between ensuring that appraisals that are conducted by a separate company
right.
are accurate and free from prohibited bias, all the while preserving that independence and the separateness that the regulations require. So that's what I see as the fair lending priorities these days.
Yeah, that's there's a lot of things for lenders to be considering. What would you tell lenders as far as priorities for the CFPB going into 2025?
Well, like so many other things, I think that really depends on the outcome of the election. We all know that Director Chopra has focused on proactively seeking out redlining and directing lenders to take affirmative actions and invest millions of dollars in underserved communities. And he has a keen eye on what he terms as junk fees, which can seem to mean anything from the cost of credit reports and title insurance, or depending on the day, discount point. So I imagine there's a chance that if Vice President Harris wins, those will continue to be priorities. But having said that, there often is significant turnover in Washington, D.C., even if it's a second term of the same party. So
Mm.
I wouldn't be surprised if Director Chopra does not stay after a Harris win, and it's hard to say what kind of different priorities a new director under that administration would have. Of course, if Donald Trump wins the election, it's very likely he would appoint a much different director.
Right.
During his term, the CFPB certainly brought some enforcement actions, but I would say they were kind of carefully contained and certainly a different tone. So I think we would have a more deliberate and constrained CFPB. And we can also expect that a Trump appointee would probably take a very hard look at any recent or outstanding regulations, like the new proposed mortgage servicing regulations. I bet there's a good chance that those regulations will get a significant hard rethinking or even withdrawal. But I do think that either election scenario would result in a focus on really serious issues of affordable mortgage credit and the availability of homeowners insurance and the extent to which the agency can do anything to make the mortgage process more efficient, the product less expensive. I'm not sure exactly how the two different CFPBs would do that or solve those problems, but I do think that will be a priority regardless of who wins.
And yeah, that kind of leads me my next question. We were talking about, the availability of credit and affordability all the way around. We're better 24 and better than 23, but lenders are still in a challenging origination market. How do you help clients find innovative ways to provide mortgage products?
Well, it is a challenging environment and it continues to sort of stretch out. And my clients, your members, have certainly been trying to find innovative solutions for consumers to tap into home equity. I've been helping clients kind of navigate the compliance environment related to some sort of non-traditional, if not unheard of products, but products like HELOCs, closed-end subordinate lien loans, non-QMs, business purpose loans like debt service coverage ratio loans, or even so-called fix and flip loans. Shared appreciation mortgages may be coming back, and other products that aren't even loans, but are more like a partnership investment opportunity between the borrower, for lack of a better word, and the company. So some of those products are fairly straightforward, but there are new questions about licensing,
Right.
rate and fee limits, disclosures, and the answers are a bit different than from the traditional mortgages that we all have down to a science. So,
Right.
so yeah, and in some of those products, the CFPB hasn't really provided much guidance, and they still seem to be in a learning mode. We don't have decades of history under our belts for those products, so I've been helping them, my clients, understand and analyze the opportunities and the compliance issues in those products.
Yeah, there's a lot to you want to be creative when there's a tough market, right? But then you have to also think about, as you say, the regulatory compliance that
Yeah,
surrounds those products. So thank
right.
you. Thank you for that. Kris, you've been a great volunteer for the California MBA, participating in, some of our committees. We really appreciate, of course, Mayor Brown's sponsorship for our upcoming big legal issues and regulatory compliance conference.
Yeah.
It's happening at the beginning of December in Southern California. Can you share with our listeners why you choose to support the California MBA?
Oh, absolutely. I mean, we are so happy to support and participate with the California MBA and Mayor Brown in general, and I in particular highly value our membership in the association. I mean, California is obviously a critical marketplace to every one of our clients. It's one of the most important venues for housing finance policy because the state's legislative and regulatory priorities and enactments have a broad-based trend-setting effect. I can remember specifically an issue came up related to some proposed legislation that would significantly affect my clients, and my first stop was the California MBA. I mean, not only was the association on top of it, on top of the substance, but I was able to learn about all the efforts the association had already taken to educate legislators on the impact of the measure. And that kind of expertise is just, it's simply top tier and it's critical to our industry. But I would like to say too that I really appreciate the emphasis that the California MBA places on young professionals, on diversity and inclusion, and in particular on the women in our industry. And one thing I love about the mortgage industry is that there are a lot of really smart women. And from my perspective, it's an industry in which really smart women can and do shine. So I really appreciate the events the association has hosted that focus on women, the podcasts that focus on diversity in the industry. So well done, California MBA.
Thank you so much, Kris. I appreciate that. And I look forward to seeing you at our conference in December.
Yeah, I'm looking forward to it. Thank you.
Thanks for being on today. And thanks to all of you for joining us in today's episode. To access any of our past episodes, you can follow us on our YouTube channel. We're also available on SoundCloud, Apple Podcast, and Spotify. That's it for this week, and we'll see you next time on Connect.
Here we go.